I know in the break we were just chatting, and I was thinking we'd start with a Europe conversation, but given the moves in the dollar, seems appropriate to cast our minds stateside and to think about the Treasury market move, which seems to be one of the big moves of the morning. Simon, your thoughts on Treasuries on the rise here and the link with the dollar, because we do see Treasuries up. We were testing 1.76% on the US 10-year and the dollar on the rise. Your thoughts on that link?
Yeah, I think the links proved very influential for FX markets over the beginning part of the year, especially when pricing the initial COVID relief plan. But as we progress further into 2021, the more the emphasis is going to actually come back to the front end of the US yield curve, specifically the 2-year, and what that means for market expectations for the Federal Reserve. And our understanding is that based upon the last Fed meeting, they're going to do a very good job at almost anchoring that front end of the yield curve. So what we're going to start seeing is a bit more of a disconnect between how the 10-year is trading and the broader US dollar, unless it comes back into the haven properties of the dollar and how fixed income markets are behaving. But on this reflationary side, the emphasis is going to start to incrementally go back to the 2-year. And with the Fed doing quite a good job at the moment of anchoring that 2-year real rate, we expect mild US dollar depreciation across the board. Now, it's early on in the year for this to actually be occurring, and we've still got quite a long way to go, especially with the reopening and the vaccine efforts and still US economic outperformance. But we think that the dollar's holding quite a high valuation at the moment, and it leaves quite a lot of scope for negative surprises.
And Simon, what dictates then whether the FX markets are focused on that 2-year horizon, as you say, and you suggest that could be bearish for the dollar, or focused on a little further up the curve and the spreads that are available, maybe at 10-year horizons, and comparing the US with other parts of the world? And if we continue to see yields in the US ramping up faster and that spread between treasuries and other sovereigns widening, why will that not mean a stronger dollar?
Well, FX markets really care about what's here and now, and the whole reason why the emphasis was on the 10-year, it was the most liquid part of the curve, and central banks after the pandemic practically killed spreads on the front end of the curve. They said rates are going to stay low, loose monetary policy for as long as it takes, for the next 2, 3, 4 years in some cases. So the spreads available on the front end of the curve were pretty much non-existent. So the emphasis very much went on the longer dated securities, and what the overall vista was for the economic outlook over the next 10 years tends to be how long a cycle takes in economic terms. So what does the whole picture look like for the recovery? And so FX markets were very much focusing on that. But what we're going to start seeing now, especially with the Federal Reserve shift towards an average inflation target, and as that 2-year starts to incorporate more of the 2023 horizon that markets are betting on the Federal Reserve to start hiking, is that you're going to start to see all of a sudden central bank policy divergence come into play, and who's going to be the first one to react. And arguably, the Federal Reserve almost splits the field within the G10 space. So once this starts to occur, we are going to start to see, some currencies where the vaccinations are aggressive, the fiscal stimulus is on par in percentage terms with the US. They're going to start to chip away at the broader US dollar over time. So it really depends on where central banks are kind of pointing, where we're expecting liftoff, but not even liftoff, the initial signs of normalization. And once that 2-year starts to incorporate more of 2023, which is under a lot of scrutiny for the Federal Reserve's actions, we're going to start to see that 2-year become more of a dominant factor within FX markets.